two primary ways that you can use velocity banking on this channel. For the last 5-6 years, I've focused a majority of the case study videos, the topics on one way of doing velocity banking. And today I'll spend a little time, probably majority of our time, talking about that other way that we can use velocity banking that arguably is probably the most advantageous way to go. It just involves more risk than how it's typically taught. So that's one aspect. It can yield a much higher result, but again, there's definitely more risk to considering this other way, right? And what I am referring to is basically creating cash flow, okay? So velocity banking is a concept, it's a strategy, it's not a product, okay? It is a way of thinking, it's a theory that has been proven, right? It started in Australia, worked its way over to the United States. In the United States particularly, the way to incorporate this strategy is by getting in partnership with certain types of banks that offer certain types of products. Those products are credit cards, personal and business lines of credit, home equity line of credit in the first or second position. Those are your primary products from the bank. You also have a cash value collateral line of credit, but that involves another product that you would have to have called whole life insurance in order to have that particular strategy, right? In order to have that particular product, okay? And we're using those products predominantly to accelerate another debt that you have in your finances that you're trying to get rid of. This could be a mortgage, student loans, personal loans, other credit cards, any type of high interest debt that you're trying to eliminate to create cash flow. So that's the primary, most popular taught way of doing velocity banking. Is you're leveraging lines of credits to accelerate debts, to save money on interest, pay off your debt faster than the traditional way of getting out of debt. And in the end, that creates a guaranteed cash flow gain because you no longer have that debt. The other cool part about doing this particular strategy is you're remaining liquid in the process of eliminating debt. What do I mean by that? Well, if someone has a cash flow of $1,500 a month and they're sending 100% of that discretionary income toward their debt each and every month, they are not liquid. If an unexpected event comes up, a life circumstance, whatever it may be, they now have to pull from somewhere else to cover that unexpected expense. That's either coming from their savings, coming from liquidation of an asset, selling stuff, having to work more hours, make more money to cover that difference, or what most people do, they go into more debt. They're trying to get out of debt. Now they're going into more debt to cover this unexpected expense. So it's not cookie cutter, make extra payments each and every month and you'll get out of debt. If that were so easy, everybody would be pretty much debt free. But that is not the case. Why? Because life happened. And what most people who only teach debt elimination from the traditional standpoint of just making extra payments, you will never see them incorporate unexpected life expenses. You won't see it. So it always looks, cookie cutter, easy. This is so simple, right? Life's easy and all that stuff. But then the people like you that are watching end up having unexpected life things occur and it derails your strategy. And to get back onto your debt elimination strategy takes usually the average person about 30 to 60 days to kind of recover, reorganize, okay, what's my cash flow now this month? And then you're starting up those extra payments again. Whereas in the velocity banking space, you could have same income, same cash flow, same things going on, have an unexpected expense come up, and we know exactly how to handle it. Matter of fact, we incorporated it into our strategy so that we set proper expectations. We remained liquid, so when something did come up, we knew where to pull it from for the cheapest cost possible, and there was no delay time. There was no downtime. There was no questioning, okay, when do I start back up on my debt elimination process? Because when you're doing velocity banking, your first move is what we call a chunk. So you're taking a lump sum of money from the bank to eliminate another debt, to reduce interest, to create cash flow. So that's almost instant that's occurring typically, right? Depending on how big the debt is. So there's an instant interest savings, an instant cash flow gain typically, right? And then you're doing velocity banking at that point with all of your income in, expenses out, cash flow stays. So 100% of our cash flow in the first month of doing velocity banking is there. We didn't lose it because we used the bank's money first, and now we're simply paying ourselves back what we just did in that. Then what happens is you're doing velocity banking, right? 2-3 months go by, boom, an unexpected $3,000 expense comes along. In your mind, you're like, okay, I have a line of credit here for 30 grand. I made a chunk of 10 and I owe 7. So now I have this $3,000 expense is going to come out of the line of credit. Boom, it's going to bring my line of credit up to 10. I don't have to think. There's no downtime. Immediately, I handle that unexpected expense because I already accounted for it in my chunking strategy and my numbers, all this stuff, and we move right along. Yes, it takes us a little bit longer to pay off the line, just as it would if you were doing traditional, making extra payments. Now it's going to take you longer to pay off that debt, but now the downtime spent, the amount of time thinking and stress, that person incurs more time over here, whereas in velocity banking land, right? No downtime, we remain liquid, we didn't have to think about where the money's coming from, we have our tools in place, we borrowed at the cheapest cost possible. We're over there, they probably borrowed at the highest cost possible because they were not taught how to be better borrowers. See what can happen? So, with that being said, I want to, spend a lot of time answering your questions. You can go wherever you like. Okay, this is for you, the next hour, hour and a half. I just want to dedicate to the questions that you're dealing with right now. What are you holed up on? What's bothering you? What are you frustrated on? What math are you having difficulty running? Just start dropping your questions in, right? We got 26 people in the house. So I'm just going to take a quick read through these and see what's going on. Good morning to Ed. Blessings. I'm a financial person. I want to do this, help people with this, and doing it myself as well. So that's David Charles. Great. So David Charles, I'm gonna use your vision for being potentially a financial consultant, coach, strategist, someone in the financial services space where you want to help people incorporate this strategy and maybe others along the way, other strategies. You want to be able to do it for yourself. So I'm going to use you as a case study for the second way of doing velocity banking, which is creating cash flow by means of starting a business, right? By means of investing in yourself. So instead of paying off debt first, you would be using a line of credit, right? Again, this is more risk because now you're making a conscious decision to stay in debt, to carry these debts here that you may have. And you're saying, I can service these debts. I have this amount of cash flow and I feel confident to go ahead and start this business now today, create more income. So you're focusing on the top line rather than the bottom line, right? You're going top line first, create cash flow. Then you're, say, saving money, invest, and then, say pay off debt would be last, right? So I'm just going to write that here, off debt, flat.